you hear me? Okay, thanks. Okay, so we thought, this is going to be an interesting conversation because I think in front of you, you have two very different approaches of banking in general. I represent one of the most traditional banks in the world with a very large presence and following still a very traditional approach to when it comes to lending. And Charles here is actually introducing a completely new way of thinking when it comes to lending to those that are actually unbanked or that have little presence in the banking system. And I just wanted to, well, first of all, thanks, Charles, for accompanying me in this conversation.
Thank you,
why don't we start by introducing a little bit about ourselves, and then we can kick off our conversation based on what we discussed. So why don't you go ahead and start?
Sure. As Roberto said, I come from Advanced AI. We are in this, we are a FinTech company, actually born and raised in Singapore. Just about 3 years old. And we use AI and big data to empower the financial and tech industry. Mostly we focus on anti-fraud, risk and credit assessment for banks and fintechs, helping them to lend to this new to credit customer segment.
Yeah, thank you. So on my side, I've been working for Citi for over 15 years in different capacities. And as I was saying at the beginning of the conversation, I've seen the efforts that we do when we try to lend money. And usually it's all about credit scores that are very traditional in the way that we look at demographics, we look at the income of the people, and things that are easy to track because you have all of these companies that are actually doing that for us, and we just simply have to leverage those efforts to make sure that we lend to the right people. And before I let Charles tell us a little bit about what he's doing, I want to tell you a little bit of a story of lending, and especially what happened in the crisis of 2008. So imagine, a bank that has no presence in a country and wants to attract a customer base, but that country is heavily bankarized and dominated by the big national banks. So this bank that has no presence has to look for ways of lending to all of those that don't have access to that banking system. Unfortunately, that's a risk when you're talking about traditional terms, because all of those that have no access are high risk. That's why they don't have access, because they represent such a high risk that they can just simply leave the country and leave you with whatever unpaid debt they may have. And that's actually one of the causes of the crisis that happened 10 years ago. There was a lot of people that had access, very easy access to credit, without the right measures, without the right, let's say, approach. So now Charles is working on something that is completely revolutionary when it comes to lending and when it comes to looking at the customer from a different perspective. So I'm going to now let Charles tell us a little bit about what ways is he looking and how is he applying all this new artificial intelligence to look at customers in a different way and define whether they are applicable for a loan or not.
Sure. By the way, you mentioned about the crisis in 2008. Did the city also took, some of the heavy losses and got bailed out?
Yeah. So
at the time.
So, yeah, that's a good question. So, as you know, Citi used to be one of the largest banks in the banking industry. We used to have a capitalization of $250 billion. Our share price was somewhere around $60 and eventually went down to 97 cents. So that's a massive loss. We actually had to be bailed out by the US government. And because of that, we did have to change a lot in the way we were doing business. However, we still remain faithful to the way we score our customers before we give them any credit. And the question here is, will that model be sustainable throughout in the future? I question it heavily, because again, I think AI and all of these new trends of cybersecurity and is provoking new ways of thought and making companies like yours change the way we do things when it comes to lending.
Yeah, actually, it's interesting. I was actually looking at the whole online lending or peer-to-peer lending. It started before the 2008 crisis, but I think it was after the financial crisis in 2008, was probably 2011, 2012. It actually started to grow real fast in the US. I remember Lending Club and a few others went public. And I think the reason was there was really this big unmet needs that had never been filled by traditional banking. There was this big unbanked or new to credit population who actually wanted to buy iPhones. They wanted to, have a dream travel, but were not able to get the loans or were not able to have a credit card. So the online lending really grew at the time in the US. And then the whole world, especially countries like China and Europe and Southeast Asia, embraced the digital lending. But as you correctly pointed out, this is a new thing. As fast as it grew, there were a lot of, I think risk is at the central of this business model. And we got to take it very, very carefully. And AI, machine learning has been able to play critical roles in such innovative financial products. And so far, we have seen that AI have been helping some of the business model to be validated, so that credit has been extended to those new to credit customers, and help them to have access to credit, and help them actually to reduce their debt obligation. Because without the new lending, some of the people that we are serving now, or our clients are serving in countries like Indonesia, Vietnam, or India, they had to, borrow from local money lenders who actually would enforce pretty crazy collection strategies, right?
So, so kind of try to summarize what you said there, and to kind of give the people an example. One of the banks that was the least impacted by the credit crisis was BBVA, which is a Spanish group. And when the CEO was asked what were the reasons, he said that he didn't understand how the banking industry was growing at a faster pace than the economy, which is a flaw in itself, because if something promotes growth, it's lending and financing. So if you have financing that is growing at a faster pace than a mature economy, there must be something wrong in the equation. Now, what you have said just now is that there are different ways of looking at someone's ability to pay back outside of the traditional variables that we as banks look at, as I was saying, demographics, ability to pay based on the salary. But in your case, in your world, in your fintech world, what other variables do you think are starting to become more important that are also viable to determine the credit score of a person?
Definitely. I think this is especially important in Southeast Asia because in Southeast Asia, less than 10% of people have credit cards. A very small portion of these people have a credit history. So it is really hard for lenders to assess the creditworthiness of this group of people. But luckily, nowadays, other than the traditional credit data, such as demographic, income, and borrowing history, we can assess users from a lot more new dimensions, such as their social internet behavior, such as their mobile phone top-up history, such as their, for example, their mobile phone app list, what kind of apps they have on their phone. For example, if this person has a lot of lending apps on his phone, it's very likely that this person have been borrowing from different lenders, and very likely he has a higher probability to default, right?
So if I understand correctly, what you're saying is that artificial intelligence is now enabling the possibility of looking at new variables such as the behavior that a person has with his phone to be able to determine whether that person is capable of getting a loan or not. If that person has a lot of lending applications or like FinTech for lending applications in his phone, to say an example, that may mean that he's looking constantly for ways of financing himself, which may be a red light when it comes to risk, or it may also it may be translated in a different way so that it's determined that he's a good payer. I mean, as an example.
Yeah. I want to add to Roberto's point. The reason why machine learning has become more and more important is because the traditional scorecards were mostly based on logistic regression, right? But now when you're dealing with hundreds or even thousands of data dimensions, each of them have very weak predictive power. Then traditional regression model is not working that well. Instead, we're using machine learning, which actually work in a different way. It is less about regression. It's more about trying to learn and improve from the current data sets. It works with hundreds and more data dimensions, and combine all these dimensions, it will have an overall pretty good predictive power of these users' creditworthiness or likelihood to pay back the loan.
All right. So basically what you're saying is that traditional models like regression analysis is no longer powerful enough to determine, or is not as powerful as machine learning and how it's growing to predict in a much better way the future behavior of a customer with a higher level of accuracy. So changing a little bit of speed here. So what about cybersecurity? Because I understand, I mean, what you said is really interesting about looking at different ways of determining how to lend to a customer. But when it comes to fraud, when it comes to cybersecurity, when it comes to making sure that we are preventing malicious behavior from customers, how is artificial intelligence stepping in that arena? What do you see as a real groundbreaking behavior or practice for this activity?
Right. Cybersecurity is a very big topic. I think it is also very serious stuff for the financial service industry. Roberto, you work in risk and compliances. You must know how big or what kind of financial loss had incurred every year for the financial industry, right? Do you have like a ballpark number?
Globally, I don't, but I know that, in the countries that I've worked, I see that we have somewhere around 4 to 7% losses based on fraud practices. I mean, obviously, these apply for countries that are less developed than others. I mean, in countries where you have not only a bad credit score, but a good credit score and more measures to prevent, obviously those percentages go down. But I'm particularly interested in learning more about, when you mentioned something about the applications that people have in their phones, is there a correlation between that and fraud being done, let's say, to whatever fintechs are promoting lending? I mean, do you see a correlation between the fraud and the applications, and what applications, or is it completely independent?
I wish I've brought my data scientist with me to answer this question. I don't know all the details, but I do think that there is good correlation between what kind of apps installed on the phone and this user's creditworthiness. Off my top of my head, I think our data scientist told me that, for example, if this person has a lot of game apps on his phone, actually he may have a better likelihood to default. Not all these dimensions that you can find a exact rationale, but that's the way it is. For example, I remember a few weeks ago we were working with a client in Indonesia. We're looking at the user behavior on their app. This is an app that has hundreds of millions of active users, MAU, and they're eager to find out which group in their app have a higher propensity to borrow. And we actually found that people using certain types of Android phones are more likely to borrow from digital lenders. Yeah.
So it's actually quite interesting what you're saying, because I mean, you've started talking about, or we started talking about new ways of looking at the customer based on his behavior and the interaction that he has with his phone. And we mentioned, if he has certain applications or a certain number of applications, or a certain behavior with his mobile contract, he may be more prone to actually get a loan, or less prone to get a loan. And now you're shifting to, okay, so now that we know that this guy, is let's say credit worthy from our perspective, how likely is him to be a fraudster or not? And then we talk about, how much time is he spending gaming in his phone, or what certain activities. So I think, the important point here is that this is definitely a new way on how artificial intelligence is helping the community fund itself without having to go to the traditional banking, to the traditional channel, which is, the banking institutions, which we already know sometimes may not be as convenient because there's a lot of red tape, there's a lot of bureaucracy, there's a lot of sometimes you have to wait a long time to get the loan, the card, etc. Whereas in your world, it seems like it's a much more faster approach when it comes to decisioning and then the execution of the loan.
Yeah. Actually, we spend a lot of time understanding user behavior, their habits, and trying to, together with our clients, generate a better user journey. Because the clients that we serve, they lend to mostly to underserved or new to credit customers. And these customers, many of them, they don't read English, or they have difficulty navigating the complex features on their phones. So we and our clients, we partner together to develop user experience that are tailor-made for this user group. For example, traditionally when you're trying to apply for a loan, you need to go through a pretty lengthy onboarding and verification process, right? You need to go to the bank, submit all your documents, and fill in the forms. But nowadays, with AI technology, especially ID recognition technology, when you can just scan your ID and all the information on your ID together with all the information that are associated with your ID. For example, you can get the user's records from a government ID database with user consent of all the relevant information. And another one is face recognition. Face recognition has been, the technology has really developed and matured over the last few years. Now, the accuracy of recognizing a face, sometimes even with a blurry face, has improved so much that we can achieve over 95% of accuracy in recognizing a face. So with these two powerful tools, users many times, they just need to upload their ID and take a selfie or doing a short video KYC, and all the verification and anti-fraud check and credit check can be done all at the background. And the user can get a loan approval within minutes. And also with all the payment gateway technology, fund disbursement can also happen instantaneously, making the user experience in borrowing a seamless and pleasant experience.
So tell me something. If you were the risk manager for a bank or a financial institution or a fintech that is dedicated to lending, would you promote face recognition as a way of authenticating a customer to decide whether you lend him or not, him or her, the money? Do you think that we're there already where we can effectively certify that that face corresponds to that person and he or she is creditworthy? If you were the risk manager, would you feel comfortable signing that bill?
Well, nowadays, for risk manager, I think his main KPI would be the overdue rate and NPLs, which stand for non-performing loan ratio, right? These are the key metrics for risk managers. And he also works really hard to make sure that the loan performance or the interest coverage is high enough to cover the bad loans. So it has become very quantitative for risk managers, and which makes risk management the most critical part in online lending these days. Sometimes if they don't manage the approval ratio or manage the risk strategy well, he can easily turn from, say, from profit to loss. And I agree with you, which makes the digital lending still fairly risky, because a lot of this is contingent on technology and on fairly aggressive risk strategies.
So what you're saying is that the pricing of the product, the interest rate, still needs to cover that shortfall that technology has to make sure that we don't incur in a loss from a product perspective.
Correct.
Interesting. It's very interesting points, Charles. I think you've introduced a few very interesting concepts. I used to think that fintechs were a threat to the banking system, but nowadays, given that they don't have the financial power to face the lending that is required, I think that now fintechs and banking will coexist in a world where the penetration of banked people will be much higher. What do you think?
I definitely agree. I think fintech and banks, they are complementary to each other rather than pure competition. I think banks are still doing extremely well in what they do, in serving the traditional loans, in management of funding and cost of funds, and in compliances and many others. Fintechs are really good at meeting customer needs in innovative ways, and in loan management and collections for the new to credit customer segments. And I see in most of the world, fintechs actually have partnered with banks successfully. I see that happening in the US, I see that happening in China, and in Southeast Asia. I mean, I spend a lot of time in Indonesia, and actually we work with a few of the biggest banks in Indonesia. They are very open to get involved in this whole digital lending, digitalization, and they are very open to work with fintechs, providing funding and compliance guidance. And I think it is a win-win for both sides.
Okay, we're running out of time, so I'm going to open up to questions from the public, although we don't have that much public anymore. But yeah.
Thanks both for the discussion. I guess I'll start with Charles. Charles, where do you think the banks are being complacent or need to move faster in terms of technology? And for Roberto, do you think the banks are being complacent? Are they prepared for the new tech environment where you have companies like Facebook coming out with initiatives like Libra?
Also, this question was targeted to me, but I feel a little bit humbled trying to answer this question. Frankly speaking, because I never worked in banks. However, I have been, working with our bank customers, mostly in Indonesia. Actually, I feel all of them are very passionate about innovation. And we talked with some of the biggest banks in Indonesia. I found that they knows a lot about online lending. They have spent a lot of their time and they have taken initiatives in digital banking, in lending to unconventional consumers. And I think, in a way, I don't think they are complacent. I think they are very aware of the challenge from the AI age, and they have tried very hard to digitize their operations, to automate their workflows. For example, we have been working with a few banks in Indonesia on RPA initiatives or robotic process automation. I think everybody realized that this is going to happen very soon, that a lot of the workflows will be automated with intelligent RPA, so that a lot of the labor costs will be saved, improving the productivity, and improving the user experience. Yeah.
Our time is up, but I'm going to try to expand to what Charles just said. So if I were, for example, the CEO of Citi or whichever bank, I think what I would do is I would have a thorough look at my capabilities and what the fintechs are providing. And I think I would do a very thorough effort of being humble and understanding where am I strong and where am I weak. And I would eliminate all of those activities where I'm not very strong and where I know that there's a fintech out there that could actually take over that capability, that activity, and probably I would try to bring them in, because I think that's going to be much faster than if I try to develop that capability and set it to the market. Obviously, I need to take into account the regulatory part of the deal, where I cannot simply just invite anybody to walk in, but we would have to work together so that we don't get penalized by our regulators. But to answer your question specifically, I think fintechs are becoming, there's massive funding on fintech at the moment going worldwide, and if banks don't react quickly to incorporate them to the system and to cohabit, it's a clear threat. Should we have time for one more question? Any final question before we move on to the next session?
Hi, this is a question for, I guess, Charles. I'm not sure whether, Charles, you're from China or Taiwan, but my question is, from China, we know that they have the social credit system, which is pretty big, either by the vendors like Alipay, Zhima Xinyong, or the government's own social system. What do you think about this kind of system as a kind of a nationwide kind of initiative in terms of course, ensuring integrity, but also in terms of privacy considerations? What do you think about this kind of implementation generally, even for Singapore? What do you think are the blockers if those are to be implemented in the countries? And I guess this kind of system typically have quite a big component of AI inside. Yeah.
Okay. So I want to make sure that I understand the concept you brought up was social credit. Right. And first of all, I think the Alipay's Zhima credit, right? I don't think it's purely based on social credit. Actually, I think it's mostly based on transaction history of their e-commerce consumers. So I think that has been a very powerful credit data with very strong predictive power. But you are right. I think in China, alternative data have been widely accessible, not just the kind of e-commerce data that Alipay uses, but also many other dimensions, such as telecom records, such as users' social internet usage or browsing history, and ad click information. China does not enforce the most strict data privacy laws in the world, so that data, relatively speaking, are more readily available to business and consumers. And that has really the abundant availability of data of multiple dimensions has really been helpful to the online lending industry in China. That was why the digital lending has really grown to $1 trillion business a few years ago in China. That was way more than anywhere else in the world. But I have to say that data privacy has become more and more concern in China, and the regulation on data has become more and more strict, which is a good thing, I think. So I think in the future, the data privacy and and compliance are going to be a pretty big. Are going to be the same thing in Southeast Asia, I would say. I think Southeast Asia, that they're gonna. I think the government are gonna make sure that data are gonna be protected, and data privacy are gonna be respected. Robert, I think you have been working with the risk and compliance side. You must, be expert on this matter, right?
Yeah, I think that I think the social rating is definitely a good tool to know whether a person is more prone to paying back or not. But you're right. The data privacy perspective is also an important one. The moment that the regulation tightens up when it comes to sharing those details on people's behavior, I think that may be either a threat or an opportunity for a banking institution or for any financial institution to run their business. All right, I think we're well over time, so thank you guys for your attention. I hope you found this discussion interesting, and thank you so much.
Thanks a lot.